get going. So, hey everyone, welcome to our webinar about unlocking the opportunity of cryptocurrencies for financial advisors. The goal of this webinar is really to provide investment advisors the information needed to become more informed when it comes to really all facets of crypto assets. The topics that we're going to be aiming to cover is going to kind of first start really looking at the overall crypto industry as it exists today, along with cryptocurrencies as they pertain to clients' portfolios. And then lastly, how an RIA would go about getting started. My name is Griffin Knight, and I will be the moderator for this discussion. My background is in management consulting for alternative investment firms, and I am currently the head of product at Blockchain. As for a quick housekeeping item, if anyone has any questions for any of the panelists throughout the presentation, please enter them in the Zoom Q&A box, but be sure not to do it in the chat window. And we'll answer the questions at the end. I also want to note that everything said today is the opinions of the individual panelists and should not be construed as investment advice. But with that out of the way, joining me today is Dan Ayer, Baxter Hines, and Adam Blumberg. So would each of you guys mind doing a brief intro on your background and your companies? Dan, maybe let's start with you.
Great, thanks, Griffin. Thanks for attending, everyone. My name is Dan Ayer. I'm the CEO of Blockchain. I come from a background in enterprise financial planning, modeling, and analysis. We started our company about 3 years ago, and we build tools for financial advisors to manage digital assets on behalf of their clients.
Awesome. Baxter, you want to go next?
Sure. So my name is Baxter Hines. I come from a traditional asset management background. In my previous roles, I have worked for the Teacher Retirement Systems of Texas, as well as NFJ Investment Group, where I oversaw portfolios for institutional investors, high net worth individuals, and other big pools of capital. I oversaw portfolios of all kinds of dividend paying stocks in various universes and spent most of my time looking at international investments.
And then Adam.
Hi, my name is Adam Blumberg. I have been in financial services as a financial advisor since early 2009. I have my own RIA in Texas with a partner. And last year we started a company called Interaxis, where our goal is to educate people about cryptocurrency, blockchain, decentralized finance, and currently are launching a course for financial advisors so you can learn about how to make cryptocurrency and digital assets part of your practice.
Awesome. All right, so to kick things off, I wanted to start high level. So the cryptocurrency industry as a whole has certainly become a common talking point in the last 9 months, especially compared to 2018 and 2019. So really, what about the current moment particularly has enabled crypto as an asset class to continue to break into the mainstream? And really, what has helped catalyze this? So I want to get each of your takes on this, but maybe Baxter, let's start with you.
Yeah, sure. And thank you, Griffin, for moderating this presentation. And thank you to everyone at Blockchain for including me as a panelist. I'll answer that question by first of all just saying this is a really exciting time to be in finance. We are going through a period of economic, social, and political uncertainty on a global scale. And we've been really going through this for the last roughly 10 years, which when we started off with the global financial crisis of 2008, 2009, and there have been various events that have happened in between now and then, including the European debt crisis. You saw the energy business really fall apart back in 2015. But this most recent event, the COVID-19 outbreak, really sent everything into sort of pandemonium again. And the traditional way that we've been seeing governments around the world handle this is to have central banks start to print money and go in these periods of what's known as quantitative easing. And then governments will just accelerate their spending and increase their deficits to the point where here we are today in the United States, where roughly 20% of our GDP is now being represented as a deficit to our fiscal budgets. So all of this activity by governments and this continued response of just simply printing money and really taking it into overdrive recently has caused a lot of people to question the need for sound money. And people are starting to look for alternative methods to store value because there are so many worries about inflation coming down the pike and really taking a bite out of the purchasing power of the currencies that we've used all of our lives. And so one of the things people are looking to are these cryptocurrencies. And cryptos like Bitcoin, for example, have been very, very successful investments for a small group of investors who got in early but have continued to increase their positions over time. The mainstream has not really gotten into that for several reasons. One is there's several negative headlines around the cryptocurrencies. Second, there are a lot of regulatory questions. And third, people just don't know how to go out and buy the stuff if they wanted to. But that sentiment has really shifted 180 degrees in the last few months with COVID-19. Is causing people to rethink things. And here you are now where mainstream investors who are highly respected, like Paul Tudor Jones, Bill Miller, Mike Novogratz, they're all getting into crypto in a big way. You're hearing business leaders like Abigail Johnson at Fidelity, or today you're seeing where Square, Jack Dorsey's company, has put roughly $50 million into Bitcoin as an alternative to cash for the company. And a few weeks ago, you saw MicroStrategy have hundreds of millions of dollars on its balance sheet of crypto. So because of all these positive headlines, you're getting more and more mainstream people who are asking their financial advisors about digital assets and how do they get into it. And in fact, the surveys would say that over 80% of all financial advisors have had at least one of their clients bring that question up with them in the last year. And if you look at these surveys over time, that number just keeps going up every year, year after year. And so I think the environment is really right to be asking the question, why should we be getting involved in crypto? The sentiment's there, the regulatory picture is a lot clearer. And most importantly, now the infrastructure, the ways to trade, custody, and report on these assets is available. And so I think that's going to really help take the adoption to a whole new level.
Yeah, no, I couldn't agree more. Yeah, waking up this morning to that Square news, I think it's a big deal with a company that kind of that stature. Maybe Dan, let's have you go next. Maybe also kind of geared more towards kind of the history and particularly the financial infrastructure that we've seen.
Yeah, sure. So to really understand this, how we got here, you have to rewind a little bit. And Baxter mentioned this briefly, but the 2008 crisis was really a catalyst for a lot of these new technologies to be born. So due to the financial impropriety in 2008, that was absolutely rampant. In 2009, the first cryptocurrency was created, and the whole idea behind it was that people could take ownership of their own assets. They didn't need middlemen to do that, and that it was kind of an ideological thing at first. And that first cryptocurrency was called Bitcoin, and it was a little while. It took until 2010 before there was a real world transaction. I mean, it was kind of the idea at first, but there's a famous story about the first multi-billion-dollar pizza that was purchased using Bitcoin in the real world. And so that happened in 2010. And in 2013, there was a federal judge that actually called Bitcoin a currency, form of currency. And that was the first time that it gained any sort of legitimacy inside of the system that we operate within today. And then there were a number of entities, corporate entities, that began accepting Bitcoin as a form of payment. There's stories about organizations like Microsoft, and there's a number of other very legitimate organizations that started accepting that early. That trend has only continued. In 2015, the premise that Bitcoin had brought to kind of transacting as a form of payment, a unit of account, or a currency specifically, that same premise was kind of widened using the Ethereum blockchain to all other types of use cases that aren't only specific to currency, decentralized applications and so on. And after that happened, I think this technology started becoming a lot more interesting to banks and other financial institutions that were exploring already the underlying infrastructure of Bitcoin, trying to understand how the technology behind payments was evolving. The application of that distributed ledger technology to their own operations internally became a sticking point. And after that, we really started to see this propagation of exchanges, liquidity providers, and custodians around the globe. I mean, there were hundreds of them, many different projects, thousands of assets. And in 2017, we saw a pretty massive spike. And I think that drew a lot of attention globally to the asset class. I mean, it hadn't been around for that long at the time, about 7 years. But that was kind of where the bubble initially burst, and we came back down to earth, and everyone got really serious about the technology. A lot of the institutional infrastructure started emerging really in 2017 and beyond. I mean, there was work on it before that, but it really continued with earnest moving forward after 2017, because I think a lot of folks really realized that it wasn't going away. In 2019, the asset class was added to the CFA exam. So for those of you here that don't know, CFA is you can think of it a little bit like the PhD of the financial world. And so, in order to become certified, you need to know about this asset class now. And that's a good sign of kind of impending adoption and awareness. And then most recently, there was the Office of the Comptroller of the Currency that announced that banks could actually custody crypto assets. And that was a huge step forward, bringing some legitimacy to it that, you simply could not have gotten any other way. And it really signals now that there's a little bit of a race to see where this technology is going to go for these larger organizations. Today, there are a number of options, speaking from an infrastructure perspective. There are tons of different custody products out there, hundreds of exchanges globally, as I mentioned. There are funds for institutional investors. You could take 401k and IRA account allocations, and there are digital turnkey asset management platforms, which is what we do. And then, there are blockchain exclusive tech that if you wanted to access them directly, you could do that. And the DeFi ecosystem is really popular right now as a way to, to do things in a much more peer-to-peer manner. And so that's kind of where we are today and the infrastructure that's available. And we'll get more into some of that stuff later, but that's really where we are today.
Yeah, no, definitely. It's crazy to see how much has changed even in the last couple of years. All right, and Adam, do you have anything kind of to add to what Dan and Baxter said?
Real quickly, I'll say Baxter and Dan summed it up really well to take, Dan's history of it and where we started with Bitcoin and the ethos and why it was even created, which ironically was to deregulate, right? To go to disintermediate and to get around regulators and to get around banks and around financial institutions, to where we are now, where Bitcoin itself is kind of its own asset class, and we built this infrastructure around it, meaning there's lending, there's custodial facilities, there's insurance around it, and all that. And then you have the other cryptocurrencies, the DeFi and the Ethereum that Dan alluded to, that have kind of taken that ethos of disintermediation and lowering fees and friction, and have done some really exciting financial products and financial services that have gotten a lot of headlines, have gotten a lot more people in the world involved and into finance and into economics and into the ecosystem. And that's what's really exciting. So now as financial advisors, we start to get more and more people that are interested in this. On top of that, we have occurrences. We have things like Robinhood, where we've seen so many people try to kind of do their own finances and do their own trading and really get involved. Whether that's good or bad is not for me to say. However, what we see is there are investors that really want to take control, and they want something that's extremely customizable. They want something that's for them. They want something different. They want things like alternatives, which is why they're going to Robinhood. They can't get normally through an advisor. So now as financial advisors, it's exciting because you potentially have this alternative type asset class that you can actually offer to your clients. And now we finally get the infrastructure to be able to do it in a safe way and to be able to do it in a way where you as the advisor can actually earn money. You can actually earn fees while helping your clients with this, while helping them make it part of their portfolio. help make it part of their overall financial, personal finances. And that's what's really exciting now, is that it's all kind of come together at this perfect time for it. And here we are on this call trying to help financial advisors understand how to make it part of their practice.
Yeah, no, definitely. And I think that segues us nicely into the next section, which is really kind of about crypto as it fits into a portfolio, and particularly in regards to how a client would view it. So, Dan, this next question I'll direct to you. Maybe if you could touch briefly on what particular performance metrics stand out really as evidence of crypto's value as an investment, both as standalone and within a portfolio.
Yeah, so I think this boils down to two key things. There's returns and there's correlations. There's plenty of other stuff that you could go into from a fundamentals perspective, but for right now, I think it's good to keep it a little bit higher level. So if you look at the risk-adjusted returns of crypto assets as a category or as an asset class, they vastly outperform all other asset classes over the last decade. I mean, it's a fact. So, from a purely risk-adjusted return perspective, it's an impressive outcome. In recent months, Bitcoin and other crypto assets have seen higher correlations to traditional markets, which, the whole idea of using it as a diversity play versus the S&P or other traditional markets, it's historically been very interesting. And I think, with black swan events like COVID, I mean, everything took a hit, right? And we saw more correlation even with gold and other alternatives. But historically speaking, outside of these black swan events, these assets are not correlated to traditional markets. And actually, contrary to popular belief, Bitcoin is not any more correlated with gold as a speculative store of value than it is with other major financial markets, right? So it's one way to diversify with additional non-correlated assets. It's an and, not an or, with gold. And if you look at something like the Sortino ratio or the Sharpe ratio, we can see that while Bitcoin is volatile, that volatility is primarily upside. So I would say that those are probably the highlights of it, at least at this stage. And we can dive into a little bit more detail later if you want to get into that.
Yeah, definitely. No, that makes sense. It'll be exciting to see kind of how the correlation goes from here as crypto grows in size. All right, so my next question is it pertains to, I guess, the less tangible side of offering crypto as an investment to clients. But even if an advisor buys into the value proposition of crypto assets, wouldn't the volatility itself be somewhat hard to stomach for the majority of clients? Maybe Baxter, you could take this one.
Yeah, sure. I think, just to kind of add to what Dan was just saying, in business, there's often this saying that there are no free lunches. Well, in the world of finance, the only free lunch that you get is diversification. One of the best paths to building a better portfolio for your clients is just to simply raise the number of uncorrelated assets, because from a purely academic standpoint, what you're doing is in essence expanding what's known of as the efficient frontier. You're getting that better risk reward trade-off. And in today's market, investors are desiring more customized investment solutions. They want accessibility to new and unique pools of liquidity, and they want technology that enables them to stay engaged. And so as we're seeing in this time of COVID, the strategic asset allocations of a lot of financial advisors are changing. You're seeing this gravitation towards alternatives like private equity, private real estate, precious metals or commodities, other asset classes that are being included to improve this risk reward trade-off. Not only are financial advisors doing that to create, again, that better risk reward metric, but they're also doing that to differentiate themselves from their competitors. So if you think about ways to make for a better asset management practice, you would want to start having conversations around asset classes like digital assets, crypto, because what that does is it one, gives you a different conversation with your clients, but it also protects you from other people who you're competing with for those same clients who might be having that conversation. So you at least want to start having yourself in that conversation. And so I think, again, given the volatility in the marketplace, in stocks, or the low fixed income yields that are out there right now. Really, the way that crypto behaves, and it can oftentimes be volatile, it's really about how it fits in with the other assets that you have in your portfolio. So it's really about how, again, how these things correlate, which I think Dan really alluded to very well. But in summation, I would say, financial advisors need to be creative, they need to be innovative with their allocations, and they need to find opportunities in which to create investment returns that fit their client needs. So I think you're going to continue to see this shift towards these uncorrelated assets and new products, and because most asset managers today are saying in the surveys that we read that they need to broaden their asset class mix. And so I think that adding crypto and digital assets is a really win-win solution for the advisor and for the clients, and it should be something that they should consider putting in their toolkit.
Yeah, no, definitely that makes sense. Do either of you have anything to add on that? Awesome. All right.
I'll add that.
Go ahead.
Because we had a bit of a question also talking about a fiduciary duty and talking to clients about this. So this webinar is kind of the beginning of this, but the goal is for advisors, and the goal from a fiduciary perspective for advisors is somewhat to understand the asset classes that, or understand the assets, the asset classes, the investments, not only that your clients are in, but that they could be in and that they want to be in, and how it impacts their overall financial picture. So if in the past you've had clients that have been asking you about cryptocurrency or digital assets, and the answer is one of kind of like, I don't understand it, and therefore we're not going to talk about it, we're not going to put it in your portfolio, is not really an acceptable answer from a fiduciary perspective. If you go and understand and learn more about it, and you still have decided, based on my clients and based on what I know and what I can help with, based on their risk profiles, their ages, what have you, it's still not acceptable, that's fine, and that's that's what you do as a financial advisor. But an acceptable answer is not, I don't understand it, and therefore we're not going to talk about it, especially if your clients are asking about it. So from a fiduciary perspective, it starts with at least somewhat educating yourself on this new asset class, the same way as you educate yourself a bit on other asset classes like gold and other asset classes like real estate and such. You educate yourself on them. You don't have to be a complete expert, but enough to where you can answer those questions and talk about where it fits in a client portfolio. So that's what's really important, I think, is not only that the run that Bitcoin has had, or the run that crypto has had in whatever 90,000%, but understanding how cryptocurrencies work, what impact they'll have in the future, what they're going to drive, why companies like MicroStrategy and Square are buying Bitcoin and holding it in their treasury, what purpose that serves for them, and then how to do it safely, right? Because you as the advisor need to figure out how to do this safely and securely and actually help your clients make it part of a portfolio, make it not speculative anymore. And that goes along with what Dan and Baxter have been saying, is you have the infrastructure, you have this run up, you have the ability to look at correlations or non-correlations, and you should know as an advisor how that fits, how non-correlation works, how it helps with diversification, how you need assets like that in a portfolio, and then you need to rebalance. Well, this is, Bitcoin's kind of perfect for that, right? Because it's non-correlated and it's volatile. So as a financial advisor, we feel like you should at least learn about it a little bit. And then if you decide from that perspective that it fits for your clients, then it fits, and you learn a whole lot more, and you learn how to do it safely.
Yeah, no, I totally agree. And I guess kind of to add on to that is, assuming that the advisor has got knowledgeable about it, what's kind of the best way to talk with a client about it, without maybe getting too into the technicals?
I'll take this one. So talking to a client about it, on one hand, there's a lot of, say, fund companies and such kind of pushing this narrative of you need to get your clients into Bitcoin. You need to get them into cryptocurrency now. Get off zero is kind of the big one we talk about. And it's really hard to get a client from no cryptocurrency, not even asked about it, nothing about it, to go, you need to buy some cryptocurrency, because it takes a whole education process. And there might be a reason why they didn't want it. Maybe it's a technical thing, maybe it's a risk thing, maybe they just don't understand it. And as a financial advisor, I don't want to deal with that. Like, I don't want to deal with Bitcoin goes down 50% and they call me yelling and crying and everything, even though it was such a small percent of their portfolio. Now, on the flip side, you have clients that have been asking, or actually have it sitting in a Coinbase account or something. They've actually bought it, or they've tried it, or they've researched a little bit. And those are the types of clients that you start with having the conversation. Why do you want this? Why are you interested in it? Why did you buy it to begin with? And then we go, all right, do we want to make this, instead of a speculative buy, and instead of trying to get it going, 10 or 20x, do we want to make this a part of our portfolio? Well, I, as the advisor, have been educated enough to say, I feel like it's okay to allocate some to this based on your risk profile. We can go 1 to 5%. And if you look at it from a numbers perspective, if I have $100,000 to invest and I put 5% in the crypto, that's $5,000. Well, if it goes down by 50%, which would be a really, really bad day, I would be down $2,500 in a portfolio of $100,000. Well, that's not a massive hit overall. It looks bad. The 50% of that allocation looks bad, but overall it's not a massive hit. Knowing full well that Bitcoin or crypto could easily go 2x, and all of a sudden that 5 turned into 10, and it looks really good. So the downside versus the upside, the risk versus reward for such a small percent of your portfolio is pretty good, especially when you go, all right, what if that Bitcoin went up, doubled in value, and I rebalanced like I should as part of a diversification strategy. I sold half of it, went out and bought other equities or whatever I did with it, and now I've got a great looking portfolio again. I'm back to 5% crypto, 95% whatever else I do, and I'm that much better. So those are the conversations, because now as an advisor, you're going, look, I'm watching out for you, and I'm not making this a speculation. We're not trying to go Lambo on this. We're trying to figure out how it's really a part of your financial plan, and I'm listening to you, and we're trying to actually do something to help you and get more creative and find these kind of alternative asset classes that you as a retail client can actually get into.
Yeah, no, I'm definitely, when it comes to that, the risk reward payoff, I think it's significant. All right, so next question, maybe for you, Dan. Who is the potential or best clientele that kind of fits the crypto narrative and makes the most sense in their portfolio? Or is there an ideal clientele?
Yeah, so I think there's sort of the obvious clientele, and then there's the less obvious clientele, but I think both are totally legitimate. I'll start with the obvious one, then we'll talk a little bit about the less obvious one as well. So I don't think it's any secret that there are changing demographics in the wealth management space. Clients are, on average, younger. They're becoming more tech savvy. They have more of an appetite for risk, and they're looking for wealth management firms that are ideologically aligned with where they'd like to go. And so if we look at the size of that group, that's about 73 million individuals in the United States alone. That's actually the largest demographic in the world. We call it the millennial demographic, right? But it's about 22% of the population. And they are entering their highest earning years. They have capital to invest. And actually, if you look at the data, they're not as interested in gold as they are in Bitcoin, for example. And I think that just points to a broader trend. You even heard comments from Jim indicated that he's interested in buying Bitcoin for his children to inherit as part of his estate. I think that that's the broader trend, right? Is that we're heading more towards technology enabled investments from a millennial clientele. But I don't think that's the only clientele that this is relevant to. Baxter was telling the diversification story earlier, and as I mentioned before, it's an and with gold, not an or. So no matter what your age is, you want to maximize the amount of diversification that you have in your portfolio. especially in uncertain times like we're going through right now. If you want to shield, the rest of your assets, you want to account for every different type of scenario that could arise. And I think crypto is a pretty interesting and important part of that picture. To what extent is a question that's specific to each individual firm. But I do think that this isn't specific to just one demographic.
Yeah, I would add a couple things to that. I think that the perceptions around this are changing. The studies are showing that a larger and larger portion of the population is viewing this asset class favorably. So don't have a tunnel vision idea that it's just around young people that you would want to market this to. Again, studies are showing that a lot of financial advisors, they know their clients are buying crypto, but maybe aren't having the conversation with them because they just don't know how to have the conversation, or they don't want to, admit this to their financial advisor. Be open with your clients, talk to them about this, and have a solution where they can actually, house that with you, the financial advisor. I think, one of the biggest risks that a person who is in the financial advisement business has with their clients, it comes around the passing away of one of those clients. How do they retain those assets when the money gets passed down to their heirs? That alludes to, again, Dan, what you were talking about, the younger demographic. You want to be able to have a more complete package to offer to them. You also, what you don't want happening is maybe there is someone who's an older client who has this crypto and it's stored away and some sort of password gets lost. Well, the assets are gone completely out the door if a situation like that happens. So it's in some ways it's a risk mitigation tool to the client to have the conversation. It's also for the financial advisor or the RIA. It's a risk mitigation tool for their business, because you want to be able to retain those assets when they get passed down to those younger clientele.
All right, and real quick, let me piggyback on that real quick, because we alluded to it a little bit earlier, but there are clients that have already purchased it or already interested, and it's incumbent on us to start asking it, at least say, guess what, I know about cryptocurrency now, or I know about Bitcoin, and maybe those clients will come out and go, guess what, I have some, or I was talking to my mom or dad about it and they actually bought some. And then you have to have those conversations, right? And, look at the fact that we have, $50 trillion wealth transfer coming down in the next 10 years or so. And the younger generation is just a little bit more interested in this. They're more tech savvy. They're less into gold. They're more into Bitcoin, and they're going to be more into digital assets like cryptocurrency. So as you move from pure Bitcoin and ETH and holding cryptocurrency and trying to trade it and trying to grow it, to digital assets and understanding how real estate is going to be held and denoted on a blockchain, and understand how custody is going to be different from how you're used to it at Schwab and Fidelity, then you as the advisor are just going to have to start knowing that infrastructure. You're going to have to understand what custody looks like and security tokens look like, and be able to have those wealth transfer conversations with your clients, and the estate planning and the custody conversations with your clients now. You're going to have to understand things like valuations, where those come from, how everything fits, how you can trade all these different types of assets, because you as the advisor are going to have to be a bigger part of this now, because you're not going to be able to push it off to necessarily your custodian to do most of the heavy lifting. You might have a client that has assets custodied at 6 different crypto custodians and a hard wallet, and now you have to figure out how to help them manage all that to make sure that their spouse understands it, their kids understand it, and that they can actually use it if they want to use it.
Yeah, no, definitely. I'm glad you said that, because I think it ties nicely into the education component, which we'll touch here in a couple of minutes. But I wanted to shift the conversation a little bit to enablement. So particularly kind of around kind of the next steps for an advisor. So the first question I have on this is, given that, the advisors bought in, the clients maybe bought in as well, kind of what are my options moving forward to gain exposure to this asset class, and kind of what are the pros and cons of each? Maybe Dan, you can kick us off on this one.
Sure. Yeah. So, there are a few different ways to do this today. So you can go through a fund, which is probably the most popular way to do it today. And it is easy access from a price exposure perspective. You're usually paying high premiums though, when you go through a fund. And you don't own the underlying assets, which in this asset class, it's pretty important. I mean, it's not just an idealistic element to this. I think largely speaking, the benefits of digital assets, owning the underlying speak for themselves. You also don't have any individual tax basis because you're kind of lumped with everybody else that's invested in the fund. And that can kind of prevent things like tax loss harvesting, which in the crypto space, there's some unique benefits there because it's treated as digital property. It does not follow the same rules as securities. You can also go through hedge funds. You could get a little bit more interesting from a risk-reward relationship through hedge funds. They can, in some cases, be a little bit more expensive. You could do a little bit more exotic type things, but as a fiduciary, a lot of times you're going to be confined mostly to either a fund or going direct into the assets themselves, which is what we do as a company. Blockchain actually enables the individuals, your end clients, to own the underlying assets, while you as the advisor maintain discretionary responsibilities on trading those assets. Really it's geared towards providing a flexible and kind of customizable approach where you're not just outsourcing it to somebody else and getting some price exposure. You're actually incorporating it directly into the portfolio. You're able to do more of that stuff like tax loss harvesting and whatnot that makes the asset class so interesting. And I think it's slightly more work to set up initially, not much, but it does provide some significant superior benefits.
Gotcha. That makes sense. Yeah, so I guess I'd say, regardless of which of these options, what would be some of the common roadblocks that an advisor would run into when considering to offer crypto to their clients? Maybe Adam, you could take this one.
Well, the number one, roadblock is a regulatory one. And that's the idea that I'm getting my client into this, potentially getting my client into this asset that is seen as very risky from a technology perspective, volatility perspective. Does my client even understand it? And the regulators are very big on any, understanding any alternatives, much less cryptocurrency, something that if you don't handle it correctly can be very easily lost without hope of getting it back, as we've seen, not to scare anyone off. But from a regulatory perspective, that's one of the biggest issues. So do you as an advisor even understand and know enough about cryptocurrency to advise your clients? Do you have E&O insurance to kind of cover yourself in that respect? If something gets lost, as your, make sure as an advisor, your E&O insurance actually covers you, not necessarily because that doesn't really help the client, that just helps you, quite honestly. And then there's just going to have to be a lot of buy-in, a lot of signatures, a lot of disclosures from the client that says, you understand that this is a risky asset. You understand that what we're doing is relatively new. There's volatility. You're not going to call and be upset again when Bitcoin drops 50% one day. You're not going to sue me for it. All those kinds of things. You understand the risks here. And then you have technology issues, right? You have to talk about custody. Where am I going to custody this? How are we going to manage it? What's the plan for our cryptocurrency? What's the plan when Bitcoin goes up 100%? What's the plan when it goes down 50%? How are we rebalancing? Does my client understand what custody is like, what estate planning is like? Those are basically what it all comes down to is, as an advisor, educating yourself as to how it all works, and then just creating a plan, just like you would with any other asset class, just like you would with any other investment. When you're talking to your clients about it, you've created a plan. And if your plan is, we're going to use a system like blockchain has to be able to manage our clients' portfolios and do so in a way where we're, every quarter we're rebalancing, and they're going to be in X, in Bitcoin and ETH and whatever other, tokens that are offered by the custodian, then we do what we said we're going to do. right? That's a big thing, is what is our platform? Who's our custodian? What, from a regulatory perspective, what are we doing? And then are we making sure that our clients are on, the clients that are into this are on board and understand what all we're doing, so that when we have our regular reviews, we just have our regular reviews and we just talk about it like we do any other asset class.
Yeah, good point. All right, so question here, and maybe Adam, this is another one for you, is kind of around more specifics of education, like learning specifics, right? How much needs to be known? Does everything need to be known? Kind of how granular does that get? And really anyone can offer to chime in on this one.
Yeah, say something just at a very high level with this technology and this new, asset class and the vehicles that come along with it. One thing that I would discourage people from doing is getting into the technical parts of it. I think people get intimidated by blockchain, and they get intimidated by all of the different kind of advanced ideas around that. There's no reason to have to get into that in order to really embrace and learn why this is a new vehicle that can really create a lot of benefits for your clients. Just like if you're going to drive a car, you don't have to know everything that's going on underneath the hood. You don't have to know how the engine works or how the exhaust system operates. You need to know, the basics of how to get in the car, turn the ignition on, and get from A to B. And I would highly recommend, if you're going to go down this road, to try and help out clients to understand some of the key terms, some of the key concepts, but more to focus on the benefits and why it's important to them, as opposed to getting them confused and worried about all of the complexities that are probably not necessary.
Yeah, no, that's a good point, because there's so many different routes you could go as far as learning about it. It's quite a rabbit hole. All right, so I have one more question I want each of you to ask before we jump into Q&A, or each of you to answer. And probably looking at the future. So where are we headed? What are you excited about? What are continuous things that'll happen, push the industry forward? Maybe Dan.
Yeah, sure. So I think, this is the future of digital assets has been obviously very interesting to us as we build a technology company around it. And I think, today it's more centered around cryptocurrencies, utility tokens, the assets that are out there right now, some of the outstanding projects that are interesting from an investment perspective. But more broadly speaking, I think we're looking at formative technology of, where fintech and probably, technology at large is going to head in the future. And I think a good way to try to understand that is think about, why we're seeing this trend, more projects being brought to blockchain based infrastructure. And the answer is because it's more efficient. And markets typically find the most efficient solution, or at least close to it, over time. And so when you look at the way that securities, equities, bonds, notes, et cetera, the way that they're managed today in centralized databases with many, many middlemen, it's just not an efficient solution. And for the first time in history, technology is kind of enabling that to change and move to a more efficient infrastructure. And you even hear Jay Clayton, chairman of the SEC, he's kind of musing about this last week, I think. It was the beginning of this week, but that maybe all stocks, maybe all securities should be blockchain-based tokens. And I think, even regulators in the United States, they're open to more efficiency in our infrastructure. And if you think about kind of where this industry is, it's similar to where, the early to middle .com bubble for the internet. I think we're still sort of seeing where this is going to go. There's all kinds of interesting avenues. It's not just from a financial perspective, but if you look at, governance models is another example where this gets really interesting. In the ability to use the consensus mechanisms that are a part of blockchains, we're going to start to see a lot more involvement from the average person in how all of this functions. Now, it's not packaged quite ready for that, brand mass adoption quite yet, but I think we're getting there. You know, we're getting to a much more interesting kind of far-reaching system where this technology is behind the scenes. It's not the star of the show. It's behind the scenes, but it's absolutely essential to scaling a lot of the types of technologies that are being developed today. That's what I'm excited about.
I couldn't agree more. We're seeing a future where literally trillions of dollars of assets that are today hard and difficult to track and create will be transferred over to the blockchain. And it's exactly what you said, Dan. It's because of the better, faster, cheaper way in which blockchain allows you to move these assets around, to create them, and it creates a whole new level of transparency. So that's another reason why I would recommend people looking into digital assets now, and why it's something that should be included in your portfolio, because the technology is not going away. I can tell you some of the biggest and best companies out there from both Wall Street and Silicon Valley are putting their best people and huge amounts of dollars behind making this technology a reality. Whether it's Fidelity, if it's HSBC, Morningstar, tremendous numbers of projects are being developed, and it's going to come rather quickly, in my opinion. And so you want to be there before it happens. You want to start getting a good narrative to spread to your clients, and most importantly, take advantage of the opportunities that are coming down the pike.
What I'm really excited about, of course, is seeing more people able to invest in cryptocurrency. That's one thing. But as I talked about actually early on in this webinar, is the growth, the ethos that Bitcoin started, this idea of more inclusion and more participation and more disintermediation. And the participation that's going to bring from all over the world is exciting. So as Baxter alluded to, you start to take assets that are in the real world, assets like real estate, like gold, like bonds, like stocks, anything like that, and you can start putting them on chain, and you start marrying those with cryptocurrencies, with decentralized finance, with chains like that. And what you do is you open up an ability to take assets that usually just sat there, maybe earned a little bit of income, and now you can use them as collateral. Or you have someone, half a world away that can now borrow money from you or lend you money, and you don't have to know who they are. That's really exciting. But what that's going to cause is some of these additional companies that are being brought out, companies, projects, whatever you want to call them, by these really talented and really smart blockchain developers. What that's going to cause is new ways of having to look at value and valuations. And it's a whole new world of that when you start looking at, I'll throw some words out here that most people probably don't know, but you start looking at things like oracles and how those are going to be valued and priced, and the importance of understanding how much a gold-based cryptocurrency token might be worth. Danny actually alluded to this as well. This is like the beginning of the internet. It's most people not really understanding how it's all going to fit together until it all really starts fitting together and y'all really start using it. And then you go, oh, this isn't just fun, speculative cryptocurrency. This is a real business that has real value, and I see where assets are being put together. More people are able to use it. That's really exciting. The fact that not only am I doing this for an investment perspective, I'm doing this for an actual use perspective. I can actually use this. I can lend it. I can borrow it. I can help someone around the world, or I can help myself with my own financial plan, with my own personal financial infrastructure. That's what's really exciting to me, is seeing we're kind of going at this breakneck pace, and some things are actually breaking along the way. But the fact that there's some regulation and some infrastructure being put around it is just really exciting.
Right. There's an insatiable demand for uncorrelated assets, for assets that yield, and for new product. And blockchain is a solution to bring all three of those things to your clients. Those things you never thought you could easily put in someone's portfolio. There's going to be a time when that can happen. It's not too far off in the future. And so that's really exciting to me.
Yeah. No, it's exciting to see where we're headed. All right, so I wanted to move on now to some Q&A. So again, if anyone has any questions, be sure to add them into the Q&A section on the Zoom meeting. Let's see here. So one question here would be, let's see, I think you already answered that. All right, so what is the value? Could you explain more on the value of directly holding the underlying crypto asset? So anyone can take that.
Yeah, I mean, so I can talk a little bit to it. I'm interested to hear from Baxter and Adam as well. But the crypto ecosystem is interesting because there's all kinds of benefits that surround assets. There's a very rich ecosystem of benefits, whether it's lending or a concept called staking, where you're essentially kind of putting your assets on hold for others to utilize when you're not using them, and be rewarded for that. You don't see too many of those same benefits in traditional assets. I mean, you see some structures kind of built around that where you can achieve something somewhat similar. But I think, the higher efficiency in the digital asset ecosystem means that when you are getting a return from lending or from any other type of activity, it's higher because you're not paying 5 or 6 different middlemen, right? You're getting a bigger piece of the pie. And then, I talked about this earlier, but things like tax loss harvesting, especially for an asset class where the same types of wash rules don't really apply that would in securities. I mean, if you want to offset your gains that you saw in the stock market this year, and you have some losses that you can realize in crypto assets, you don't need to change your allocations. That could be a very, very short exercise where you just say, okay, I want to exit and enter my positions, offset those gains, and voila, you've created value for your clients. Now, I'm not saying that is going to stay that way forever. But right now, there are benefits that definitely exist there that don't exist in traditional assets. And I don't think anyone's advocating necessarily for this being a huge percentage of portfolio, but it's a good idea to have some of it in there and own the underlying assets. You can take advantage of those benefits while they exist and hopefully continue to exist.
And I would add that a lot of the funds that are available on the marketplace today, they trade at huge premiums to the net asset value. And so if you have direct ownership of the assets, you're buying the properties yourself, you're getting them at cost. You're not getting it at the inflated cost. And so you're getting a much better chance to have higher returns. And not only does that premium put you in at a higher price, but that premium could fluctuate. It could go down just as much as it could go up. And so that's another avenue by which you could be, losing out for your client if that premium were to decrease. It's not guaranteed to stay there forever.
Yeah, no, definitely. All right, so we have one question here. What are your thoughts on DeFi? Forward.
I'll take this one. We actually on our YouTube channel we talk about DeFi quite a lot. So we're pretty versed in DeFi, decentralized finance. If you don't know what it is, I can't really explain it here. Go check out our YouTube channel and we'll explain it to you. But the basics of decentralized finance is the ability to enact peer-to-peer transactions. So I, or in technical terms, my wallet can loan your wallet funds, and we can have this contract between the two that is electronic, it's immutable, all those things. And what it does is it, again, opens up more participation. You don't have to go through middlemen all the time. So the question is, what do you think of it? Is it safe? We had a question I think about, would you, as an advisor, want to learn about it or help your clients? I think absolutely you learn about it if you're interested in it. Do you put clients in some sort of actual DeFi? I kind of think you don't as an advisor right now because a lot of it is too unknown and a little bit too scary. That being said, there's some cryptocurrencies related to decentralized finance that if you understand it and your clients are young and cool with it and you want to learn about it, they're fun to understand. I think DeFi, decentralized finance, is what basically a lot of finance is going to become anyway. So once you understand it and learn that aspect, then you're ready for everything else that's going to come. Because again, we're getting the basics right now. This is the basic understanding of what blockchain and cryptocurrency and decentralized finance is right now. And once you get the basics here today, this year, everything else that comes is just going to be adding on a little bit and a little bit and a little bit. And once you understand it, once you understand custody and decentralized lendings and market makers and all that, then everything else is just going to be that much easier for you to take in and understand. And when other advisors are trying to play catch up and learn it all at once, you just have to learn this incremental bit, and you're going to get more and more clients as they start to come to you to find more yields and more opportunities and more ability to diversify their portfolio and to have more opportunities for themselves.
Yeah,
a lot of opportunity in DeFi, but I think people do have to be careful. They, like you said, Adam, they've got to know what they're getting into. This is a space that's in its infancy, kind of a Wild West environment, that some would say. And so not only do you have the risk of getting into something when it's new, but you've also got the headline risks around it. I think that there are still some things that have to be ironed out. You know, there are a lot of people that are just willing to kind of go in, kind of guns blazing into the space, and it could lead to sort of headline risks. So, you know, there's been a lot of negative headlines around crypto. It could start gravitating over towards the DeFi space just because it is, again, so new. And so you do have that added element of risk that you've got to think about as a financial advisor if you want to have those conversations with your clients, or you want to wait and just kind of see how things go. I mean, again, I think long-term, tons of opportunity there. I think it's just, you know, it's a matter of, again, comfort and what is your client's risk tolerance, and do they really understand everything that they're getting involved with?
Awesome. Yeah. So do one more question before we wrap up. Let's try and keep this short. What's the other way? Meaning diversity for investors is 95 to 100% crypto. So I'm not sure if this is pertaining to investing within a cryptocurrency allocation, or assuming the majority of a portfolio is crypto. You know, what does that remaining percent look like? So maybe covering both quickly.
Let me talk about this really quickly, because that's important, because there are some people that got into crypto really early. So if you got in and you bought Bitcoin like 2013, 2014, yeah, 95% of your portfolio is going to be Bitcoin because you bought it when it was, you know, a couple $100 and now it's 10,000. And as an investor, it's really hard to get out of something that's won like that for you. You go, I'm just going to ride this up from 10,000 to 20 to 50 to 100. But just it's no different than if you have all of your money invested in one piece of real estate or your own company or something. You have to start to diversify. But as an advisor, it's hard to have that conversation. So you start with, why did you buy it? What has the growth been? From a tax perspective, how does this affect us? And as the investor, we probably don't want to cut it all off at once, but let's start transitioning out and look at it from a tax perspective, look at it from a perspective of, okay, what are we going to go into? And then you have to talk about risk. You have to talk about feelings, right? Not to get mushy, but how are you going to feel if we roll you out of 20% of your crypto portfolio this year and crypto goes up 50%? Are you going to be angry with me and call and yell at me and call me names and everything? But then how are you going to feel also if you keep 100% in crypto and it goes down 50%? Are you going to be like, why didn't you help me get out of it? So you have to have those very real conversations and understand that I, as the advisor, I'm going to be wrong either way. But my job is my job. And my job is to help you have a better, safer portfolio.
Yeah, definitely. All right, so we're just at time here. So I want to thank all three of you for taking the time today. But the last thing I wanted to end on is, if anyone on here is interested in learning more, you can head over to blockchange.ai for more information on the Bitria platform, and you'll be able to see a demo on there. We also suggest checking out Baxter's book, Digital Finance, which covers security tokens and kind of the more that's happening in the fintech space. And that book's coming out next month. And lastly, if you're interested in really accelerating your understanding around all aspects of cryptocurrencies, then you should head over to interaxis.io for Adam's customized content, videos, and courses on really all things cryptocurrencies. I want to thank everyone, and have a good day.
Thanks, everyone.
Thanks, everyone.
Thanks for attending, and thank you for moderating and hosting this blockchain.